You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. His website, institutionaladvisors.com. Welcome to the show, Bob.
Jim, good to be with you. And we have some very interesting markets out there over the last week.
Well, people talk about Dow theory. You say it's actually working. Maybe explain what it is and how.
Well, this is one of the old technical tools put together by one of the guys who had started the Dow Jones news service, and then they were watching the markets and they realized that there was a pattern. I mean, this goes back to 1900 or something like that. Is that on a bull market, and they were the transports now were then called the rails. So a confirmation of a bull market would be on each high, the Dow Industrials and the Dow Transports would make two new highs together and then correct together and all the way up. So when you get to a very frothy market where we have been, since last summer, frothy being high momentum numbers and high sentiment numbers seen only at cyclical tops. So then you watch. So here we had the rally going into December, and the Dow Jones Industrials and the transports made their highs together right at the end of December 29th. So then there was a correction and any number of corrections, and what you watch for is to have the Dow Jones rails confirming the industrials, and that has not been happening. So we did some detailed work on this that I haven't seen elsewhere. And what we realized is that the longer the non-confirmation, that's the transports not making new highs, the more the correction is when it finally comes in. So, and anything like 6 months, if you get the 6 weeks, in 6 weeks' time, then you'd have a modest correction in the whole stock market. This one ran to last week for 10 weeks, which means it's going to be more than a modest correction. And the last couple of days have been sort of heavy in the financial markets. There was some of the bids were due in the stock market were due to good news on employment numbers, which are bogus, and some earnings numbers, which are doubtful. But anyways, in some economic numbers that were positive until about 3 or 4 weeks ago, when all of a sudden a number of the time series that mainstream economists watch were suddenly coming down. Then also you've had a tremendous narrowing of credit spreads after, credit spreads started to widen last June. That was on our schedule. And they widened right into December. And then you've had this terrific correction in them. So spreads narrowed, which is a positive, and that's been helping the stock market. But at any rate, we're looking here, and it's a heavy day in the broad stock market. And so it's saying that the old Dow theory actually is working at the moment. And there was another trick that we were using to get the stock market from, say, January on out to where we are now, and that was that the crash in crude oil ended in January, and then we counted out how many weeks that typically once the crash in crude, heavy bear market for crude ends, then the stock market will rally for a couple of months, and that counted out to March 6th to the 13th, i.e. around this week where you would have strength, but actually it was last week was the high. So anyways, we had a model that said that it would rally out to around now, and then you had the old model, the Dow theory, saying, watch out because the transports weren't there, and now it's working. So now, once the weekly numbers are in, we can put a target on the potential decline in here. We think this is going to be an intermediate decline anyways, which could be 6-7 weeks of decline in the general stock markets. But then one of the things we should look at as well is the positive items going into this recent high in North America and also in Europe, and that was the big tout that the European Central Bank would finally be figured out how to start buying some bonds. So, of course, this was talked up for a full year, and there's a lot of people bought bonds in anticipation then of the central bank buying bonds, and that program was finally implemented this week. Maybe I should say imposed. And but it looks like they've been buying the worst stuff out there. I don't think they'd be buying Russian bonds, but they're buying Greek bonds and Spanish bonds. So those yields are coming down from recent distressed highs. But of interest is that the German yield, which was down to 0.30%, 4 or 5 weeks ago, it's working on a base, perhaps a bottom here for yields. And you also, with the UK bonds, which may not be part of the European buying, and they have been basing a little in here. So the question on the British bonds is, will they stay low in yield with the buying program in Europe, or will they trade with the U.S. long-dated treasuries, which put in what we figured a very important top at the end of January. And speaking of treasuries, early in the year we were on this sector looking for an ending action rally. It would really price them up, lots of energy and lots of enthusiasm, and which we did get. And then that registered our technical stuff and advised that this could be the opposite end of 1981, when the long yield was up to 15%, and then it came all the way down to way less than 2%. So that's why we're calling it ending action. It may end that whole long period of declining interest rates. Some people may say, well, why would interest rates go up in a slowing economy? But what it has been is that the long-dated treasuries became another asset class. And I know about 5 or 6 years ago, it was longer than that, it was when Greenspan was at the Fed. He couldn't figure out why long rates were going down, excuse me, when the economy and the stock market were going up, and they called it the conundrum. And we pointed out just, well, hell, the long bond had become another asset class that was in play, and it kept going. So this is a very profound move if this is indeed the end of the action in bonds. So I think the high was 154 or something like that. So from that high, we were measuring a Pablo target around 132 on the bond. That's a hell of a sell-off. And the first crack in it was it did 10 points and then bounced back about 5 points, and then now it's withering away. So this is how you could have rising interest rates in a slowing economy or with a weakening stock market. It's just that asset class got overdone. It was just like the junk bonds last June became very overbought, and then as I said, they crashed with oil right down until December. Now here was a trick one we saw, that in 2007 the high for the stock market was set in a pattern that we'd call a false breakout or a failed upthrust, and it indeed was a sharp one in October. But the final leg of that rise in the stock market was with the correction in the junk bonds, where you had them acting favorably, and you had the upthrust, and then the next day you had the credit spread starting to widen, and that was the top in 2007 in October. Here we had the upthrust, or the false breakout, and you had the correction in narrowing credit spreads, and then they turned up a couple of days ago. So in this instance, on short term, it looks quite a bit like October of 2007. So the other part of this is that when you're in a financial asset mania world, which we have been in, that the economy doesn't go along by itself. In the olden days, you would have a high for the stock market, a recognizable cyclical peak for the stock market, but the economy would keep going up for another 10 or 12 months. So the stock market was a leading indicator, and indeed, the economists who calculate the leading index of leading indicators include the stock market in it. But the problem is that once you're in the financial mania world, the stock market and the economy more or less trade together. So, for example, in 1929, the stock market peak was in September, and the National Bureau of Economic Research, who is a semi-official body that keep track of the business cycles, that recession started in August. Then in 2007, you had the peak of the market in October, and the NBER decided that the recession started that December, which is very close, so it wasn't the usual 12-month lead. Then again, at the bottom in the financial mania world, what was the crash, ended in March, and the business expansion started in June. So the old lead lag thing no longer holds. So this is where, for the last week, when we watched, all of a sudden, buoyant economic news seemed to step back, could be turning to negative news. So this could be a killer for the whole game. And of course, nothing turns in a day. So we should let it step down. There's some moving averages that have to be taken out on the senior indexes. But let's put it this way: this week's action in the stock market looks very heavy. Also, it's been accompanied by a drop in the euro currency and another pop-up to new highs for the dollar index. And a rising senior currency is a feature of your post-bubble contraction. So let's give this one a little time.
When we return, we'll be talking about precious metals with Bob Hoye.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to market historian Bob Hoye. How are the precious metal markets reacting to the markets right now?
The market has been, in the precious metal side, has been working on a bottom. That's the best we could call it. It had a good rally and didn't become very overdone, but our approach since November was to accumulate a few gold stocks on weakness, but we did not become fully invested in the gold sector. The reason why is because we're worried about the first leg down in the overall stock market, which is happening now. So this would be a depressant to gold stocks. And on days like today, where you have a sharp rally in the dollar index, you would have a step down in the precious metal prices. But there is a point in time where if the dollar is steady to firm, there is a possibility of gold rallying in dollar terms. This would be based upon the investment demand for gold as an important place to park money, a liquidity. You know, the scared money, it doesn't want a return. It wants to be protected, but it has to go into things where you can get in and out of in an instant liquidity. So you have very good liquidity in gold, and you have good liquidity in U.S. T-bills. But as we noted a number of months ago, the liquidity went out of the long end of the bond market in the U.S. So, so this is where we get into the fundamental side of gold, that urge to park in liquidity creates the investment demand for gold. Then as you have then commodities and most everything else falling relative to the price of gold, that flows through into their operating profits. And we can see it now. You even got some gold bugs saying, weaker crude oil, that's actually good for gold mining. So here's where we make a distinction. Gold and silver priced in dollars, if you want to trade those, consider that they're a trade, not an investment. Sure, you want to have a little gold in your pocket or in your safety deposit box, just as the saying goes, in case you want to leave quickly and you need to bribe the border guard. But what you are really doing when you're positioning gold and silver, you're trading the currency. Whereas if you're an investor, you would buy the stocks, invest in the stocks, because their profitability is going to improve, and we're already in a bull market for gold's real price, and at some point it will pull the gold shares up. But in the meantime, we are maybe a few days into what could be another financial storm. So nobody's going to be bidding up gold stocks in this kind of a market, and it's not a happy note for the end of the week for precious metals people, but that's the way it is. So we would just sideline any buying programs in here and make sure you take money out of the equity market, make sure you're out of even high-grade bonds and out of junk because the spreads are going to widen. So for the careful investor, you'd want to be in 3 to 4 year high-grade corporate bonds. You get a slightly better yield, and to make sure you have some in U.S. dollars, because that play in the U.S. dollars is going to continue to earn a few basis points, over certain periods of time. So not a good news week.
Well, Bob, whenever you talk about it, it's good.
Thank you very much.
My guest has been market historian Bob Hoye. His website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net, or check out our popular YouTube channel, Talk Digital Network. Questions or comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.